Good afternoon. This is Lance Bryce with Thrive Mortgage. Today is Thursday, the 17th of March. Hope you are doing well. We're seeing interest rates continue to increase at the fastest rate in 10 years. We're up nearly a quarter of a point from this time last week. We're sitting, according to the Mortgage News Daily Survey, at 4.50 today for a 30-year fixed conforming loan. That same survey had us at 4.28 this time last week, closer to 4% the week prior. So we've moved about a half a point in the last 3 weeks or so. Here's what's driving it. The Federal Reserve did as expected. They raised a quarter of a point yesterday, but they also released a much, frankly, more aggressive approach to future rate hikes. They're predicting 7 additional hikes this year. They also discussed that at their next meeting, they are likely to unwind or start the unwinding of their balance sheet, meaning they're going to start taking some of the $9 trillion in bonds that they currently hold on their balance sheet and allow those to be sold on the market. Once that supply hits the market, that's not going to be good for rates because it increases the supply of bonds available. That drives down the price. Yields move inverse to that price. Our rates are very much tied to those yields. So that is on the pessimistic side of where rates might be headed. The flip side is, after the Fed moved yesterday, we're seeing yield curves inverse, meaning that shorter term maturities on these fixed incomes are trading at higher yields than longer term maturities. And this is due to investors wanting to shorten up their longer term positions. They don't want to be exposed on the longer end of those bond maturities. They're buying short term out of fear of recession. So an inverted yield curve is very much a strong predictor of a future recession, which we may be slipping into. Keep in mind that recessions have typically benefited interest rates and housing in the past. So there's no reason to think that that wouldn't continue as we move forward. So a bit of competing interests there between the Fed being aggressive in fighting inflation, which the bond market likes somewhat, but also doing it by putting some supply out there that may ultimately hurt us. But short term, I'm kind of inclined to suggest that we wait and see what rates are doing over the next week or so before locking in. Haven't had a floating stance in a very long time, y'all, but I think we're a bit oversold at 4.5. We may actually see these improve a little bit as we start to focus more on the possibility that a recession is likely in the near future. Hope this is helpful for you and for your clients. As always, you can find a copy of this video in your email. Feel free to forward that to your clients. There's an Apply Now tab there as well. If you have any questions, feel free to call me. I'm happy to strategize about any scenario that you might have. Have a great week, stay safe, and we will talk to you next week.